First up, Micron just reported earnings and they're down over 6%. Micron does a lot of business directly with Nvidia, so this is having a sympathy reaction. Nvidia is currently down about 1.3% in after hours following these results from Micron. Micron's Q3 adjusted EPS came in at 62 cents. The estimate was 50 cents, so that's a beat on adjusted EPS. Micron's Q3 cash flow came in at 2.48 billion. The estimate was 3.24 billion. So almost $1 billion lower than expected. That's pretty dang bad. Micron's Q3 adjusted revenue came in at 6.81 billion. The estimate was 6.67 billion. So they did beat unexpected revenue. Operating margin expanded 52.97 points year over year to 13.8%, better than the 13.0% that was expected. For Q4, revenue was guided for 7.4 billion on the low side to 7.8 billion on the high side. The estimate was 7.59 billion. So right there in the middle, 200 million lower, 200 million higher. These are just not AI results. These earnings were not terrible by any means, but for a stock that went from last earnings, I guess before their last earnings of $95 per share up to $157 per share, you gotta beat on everything, especially free cash flow missing by almost 25%. That's just not good enough to justify where the stock is. Now, obviously, the earnings call will be important, and I'm expecting a lot of volatility around that, especially your forward-looking comments about what demand looks like. Now, considering Micron and Nvidia do a lot of business together, that's also going to affect Nvidia and have a broader effect on the markets. Again, Nvidia still trading downwards, down about 1.5% here in after hours just on this Nvidia earnings report. That is it. And Micron falling more now, down about 8.5%. Seth Golden on X points out some research from Morgan Stanley that says over the past 100 years, a bull market has never ended because of economic weakness. It has always ended because of some exogenous event. That could be another banking crisis. That could be perhaps Nvidia missing on earnings. That could be perhaps the Fed that needs to raise rates again. But simply the economy slowing down in and of itself has never led to the end of a bull market. Worth mentioning, relative to the cap-weighted S&P 500, the equal weight S&P 500 is on track for its worst first 6 months of the year in the history of the index. Just to kind of show you guys this a little bit more, Game of Trades posted this. They say this is eye-opening. The S&P 500 has gained 40% since 2023, but equal weight S&P 500 has only gained 15%. It's just a handful of names that have ramped up the markets. And yes, from Zero Hedge, another concentration chart showing the 5 largest companies as a share of the S&P 500 total market cap, now at 28%, the highest you have seen ever. Like even during the dot-com bubble, you only hit about 18%. So that means during the dot-com bubble, the top 5 largest companies in the S&P 500 only accounted for 18% of the market cap. Today, the top 5% of companies in our markets, the companies you know and hear of every day, they account for 28% of the market cap in our entire markets. Let me just tell you now, we better hope there's not some kind of exogenous event, especially if you are bullish, because with that kind of concentration, that leads to flash crashes. Eric Jackson says Nvidia stock will go to $250 by the end of this year. He thinks Nvidia will essentially double up from $126 to $250 in 131 trading days. That would put Nvidia's market cap over $6 trillion. Let me know if you think that's even possible down below in the comment section. Just to kind of add to some of these stats, US equity markets have never been more expensive than the rest of the world on a price to book basis. The tech bubble, you were at about 2.5 times. Today, you're over 3.1 times. In 2021, this is roughly the same level that you were at. You barely just started to surpass that. I would say it doesn't necessarily mean markets need to fall, but stocks are expensive. That's where we get into expectations, because with stocks this expensive, all it means is expectations are high for the next 12 plus months. So you really can't afford things to go wrong, like at all. According to Bank of America, if you want to lift markets, you have to lift futures. Asset managers are net long E-mini futures have steadily been rising since the April low and nearly at the same level you've seen during the peak of July of 2021, confirming this market rally with likely room to run further. And you can see that positioning down here where you've been just steadily rising in the futures bullish bets. If you're unfamiliar with futures, it's kind of like a longer durated option, more or less, right? They trade a little bit different. They can be smaller, they can be bigger, but it's like pre-market, right? Those are futures trading. And this would suggest there's still a little bit of room to get more extended, but you are at the same level you were at during the peak in July of 2021. Seth Golden writes on X, the NASDAQ is 2% off of its all-time high. What are the odds of a 5% decline or more? On average, the NASDAQ experiences 5% or greater declines a year, one more than the SPX. Odds of a 5% decline are morphing into a larger decline of 10% or more is about 32%. So basically you have 1 in 3 odds that markets could soon fall over 10%. And if you take a look at this chart, at the same time the S&P 500 has made an over 5% move higher, you can actually see the VIX has also moved higher. And with 2024 not quite half over, the Russell 2000 year-to-date performance gap ranks as the 3rd largest in its 45-year history. If you take a look at this chart, the Russell is underperforming the S&P by 14.8% this year. The second worst year was 14.9%, so you're basically tied for the second place. The worst year was 1998, where the Russell underperformed 30.1%. But this is pretty historical what you're seeing in markets today. That is the underperformance of the Russell compared to the S&P. It's also being reported today that hedge funds have built the largest gasoline short position in more than 5 years, which really makes you wonder what's going on here, because typically oil or gasoline pricing moves in tandem with the US economy. So if you're betting that gasoline prices are going to fall, oil prices are going to fall, then you're betting on a steeper slowdown in the economy. Investor sentiment for the stock market as well as the S&P 500 using the AAII bull bear ratio and comparing this to the S&P 500 is at very euphoric levels, the same level of euphoria that you've seen back in 2021. All of these instances have preceded major corrections. But I think this is the most damning thing of all that you're going to see in this video. It is the Hindenburg omen that has just been triggered. This is a major warning signal. The Hindenburg omen was developed in 1937, giving us almost 100 years of data to evaluate its effectiveness. It has signaled important peaks on the NASDAQ 100, including 1987, 1999, 2007, and 2021. Most market signals are designed with hindsight bias, meaning their formulas are tweaked until they show good past performance. The Hindenburg omen stands out because it was established long before it could be retroactively adjusted. And if you look at this chart of other instances, the Hindenburg omen was triggered. It doesn't happen that often. Since 1998, it happened in 2000, it happened in 2008, it happened a little bit in 2015, 2016, 2018, 2020, 2021, and now it's happening again. And many of these recent peaks, like 2015, 2018, 2019, and 2021, were right before 25% drops in the NASDAQ 100. Today, the Hindenburg omen is flashing again. While not as strong as in 1999 or 2007, similar signals in the past have led to an average drawdown of 15%. The Hindenburg omen triggers when many stocks in an index hit new annual lows while the overall market trends higher. This is not normal behavior. So if you look at this chart, what's happening is the index is going higher and your average stocks within the index are hitting new lows. It's important to note that while the Hindenburg omen often precedes market corrections, it doesn't predict immediate downturns. In 2007, a similar signal appeared, but the market peaked 5 months later. Again in 2000, the Hindenburg omen flashed in December, but the market didn't peak until March of 2000. 3 months later. The Hindenburg omen isn't a precise market timing tool. It just indicates increased risk of a substantial correction. Today, if the signal strengthens, it could resemble the setups before major crashes in 2000 and 2008, just theoretically drawing another move higher in the Hindenburg omen. But it's not 100% perfect because this omen was triggered in 1997 and the Nasdaq continued higher for another 2 years. But normally, it's correct. Tom Lee over on X shared this post from Barchar that says warning signals are flashing that could send the S&P 500 plunging 70%, warns a hedge fund manager, John Hussman. Renaissance Macro Research posted this on X today. New single-family homes sold but not yet started sank to 72,000 units in May. This is a fresh cycle low and down 30.8% against last year. Expect continued declines in single-family housing starts this summer. We did get new home sales data for the month of May that came in at 0.61 million. We were expecting 0.65 million, but take a look at this. New home sales month over month came in at negative 11.3%. We were expecting positive 2.9%. So there's nothing happening in the housing market. It is basically at a complete standstill. Ganjan Binjiri over on X says there is a torrent of cash flowing to passive stock funds. U.S. passive equity funds have drawn $200 billion of inflows through May, while active has seen $130 billion in outflows. This would be the biggest annual spread between the two on record, according to Bank of America. Trucking employment is falling, and that is another warning sign because when trucking employment falls, that tends to precede recessions. Makes a lot of sense. If you're not going to be selling as many products or shipping as many products, you probably don't need as many truck drivers. Goldman Sachs says today to get your popcorn ready. On the opposite side of the month and quarter, Goldman Sachs says to get your popcorn ready. On the opposite side of month to end and quarter to end rebalancing are the best 2 weeks of the year for equity returns. No reason to expect differently in 2024. That is the first half of July. And in fact, over this 2-week period, the first 2 weeks of July in the S&P dating back to 1928, you have on average seen an over 2%, almost 2.5% return in just those 2 weeks alone. But I think whether or not we have a strong July is really going to come down to earnings and what happens with some of your first companies that report earnings. If anything, it could set you up for a weak second half of July if earnings disappoint, but we're not going to really get any big tech earnings in the first half of July. Tesla is going to be around July 20th or the 21st. Usually that same week you get Netflix, and then the following week is where you get your Amazons, your Googles, your Microsoft. So that's going to put you towards the last week in July. Here today, CNN's Fear and Greed indicator is sitting at 41. Which yesterday it was at 39. You're still in fear territory again, which is pretty interesting considering markets are near all-time highs. It's not too often do you see CNN's Fear and Greed index at fear territory and markets nearly at all-time highs. I can't recall that ever happening in the past. Here today, you have 1.33% of stocks out there on our markets, all stocks included in this, that are breaking under their 50-day moving average. So currently there's 37.07% of stocks that are above their 50-day moving average, meaning about 63% of stocks are currently in a pretty severe downtrend. And last time we were hitting these levels was back in late April, early May, and the S&P and the Nasdaq were drawing down almost 10%. Option activity for this upcoming Friday's expiration on the SPY continues to be very negative with a put to call ratio of 18. That means there's 18 times more puts than calls for this Friday's expiration. You have calls open interest of 5.21% and put open interest of 94.79%. It's like all puts for this Friday's expiration. If you take a look at today's interesting flow sentiment, you have seen 24 different trades totaling $3.25 million with a positive order value of 26%. Here today, 10-year treasury yields are up over 7 basis points to 4.31%. As you can see today, Nvidia was down 1.63%, which is having a negative impact on the broader S&P and the Nasdaq, and other big tech stocks are up a little bit, down a little bit, but Apple is up 2.36% today, really paving the way for markets to hold up. Maybe not soar, but hold up. Without Apple having this kind of a day, you would see a much weaker market today. Tomorrow morning, you will have some very important data with durable goods orders month over month. You're expecting 0.1%. Some people are forecasting negative 0.1% on a month over month basis because last month's number came in at 0.7%. So if you're still positive 0.1% from last month's 0.7% number, that's still a very strong number. If you're even negative 0.1%, it's still a pretty strong number because last month was so positive, and again, you're looking at month over month. So what would theoretically be like a really bad number would be negative 0.7% or worse. Then it'd be like, oh, whoa, what's going on here, right? So that's something to keep your eyes out for. Coming 8:30 in the morning tomorrow Eastern Standard Time. You will also get the GDP growth rate quarter over quarter, final numbers for Q1. You're actually expecting this could rise to 1.4%. We're at 1.3% right now. So a rise in GDP would probably be good for markets because, after all, if you're bullish, one of the concerns you have to have is the economy slowing too much going into recession. So GDP coming in a little bit higher would be seen as good news. Tomorrow morning as well, something I will be watching for very closely is the initial jobless claims for last week. We've seen these start to rise a lot recently, really confirming this upwards trajectory. And if you come in higher again, really higher than 243,000, that's going to be a big red flag to maybe some more weakening coming in some of your non-farm payroll reports that come out in a couple of weeks. Because again, initial jobless claims tends to be a leading indicator of what the actual job market is doing. And these are much easier to see because these claims are being actually filed with the government, so the government can see exactly how many claims are being filed. Unlike the BLS non-farm payrolls number, that is a survey, basically a self-reporting kind of thing that companies are supposed to do. When only 30% of companies do that, it's hard to get an overall picture of where the labor market actually is. So this is one of those more definitive data points that can tell you just how strong or just how weak the labor market actually is. You will get pending home sales month over month and year over year as well. Considering the really bad numbers we got today, I think markets are going to pay a little bit more attention to that. Coming out at 10 o'clock in the morning tomorrow, you will get 15-year mortgage rates, 30-year mortgage rates, 8-week bond auction, 4-week bond auction, as well as the Kansas Fed Composite Index at 11 o'clock in the morning, expecting a positive 1 number, and the Kansas Fed Manufacturing Index expecting a positive 2 number. Both of these were negative by -2 and -1 last month. So you are expecting a little bit of an improvement. In addition to the earnings that we had today in after hours with Micron, BlackBerry, Levi's, and Jeffries, we are also going to get some earnings tomorrow pre-market with Walgreens and McCormick, and then tomorrow in after hours with Nike. Sentiment on the SPY, the ETF that tracks the S&P 500 today, is bearish at 39. Yesterday it was bearish at 40. So people feeling a little bit more bearish worse today than they did yesterday. Here you can see, just looking at the broader indexes, the Russell 2000 is down 0.5%, the Nasdaq is up 0.2%, the S&P is down 0.04%, and the Dow is up 0.12%. The VIX is actually down 1.32% today, which I find interesting considering there is a lot of red out there, and even Nvidia down almost 2%. I would think that would cause the VIX to rise, but the VIX has kind of been doing its own thing for a while now. So let me know what you think about all of this information down below in the comment section. Are you all in? Are you a little bearish right now? Are you all in cash? Are you waiting to buy at lower prices? Let me know how you feel about this market and what you think is coming next. I would love your thoughts and I would love your opinions. So let me know down below in the comment section. If you made it to the end of this video and you are listening to my voice as I am speaking, well, congratulations for taking the step to better your financial future and your families. If they don't tell you, I will tell you. Thank you. You're doing them a great service by just doing this. And hopefully you love doing this and love watching these videos at the same time. So it's a win-win for everyone involved. Nonetheless, hit the like button, subscribe to the channel. If I said that, my bad. I can't remember. I'm squealing on for so long, can't even remember. You guys enjoy the rest of your day. We'll leave it at that, and I will see you in the next one.